Target just absolutely crushed the Q2 consensus on both the top and bottom lines. I mean, we are talking revenue hitting $26.54 billion.
Right, which easily beat that $26.13 billion estimate.
Exactly. And the EPS, the earnings per share, came in at a massive $4.11. That's versus a $2.33 expectation. Plus, management raised their full-year guidance.
Yeah, they're projecting around, 5% net sales growth now.
Right, and they lifted the ETS range to between $9.90 and $10.90. So just a massive beat across the board.
It is, but, well, the stock reaction tells you a lot about how complex this report actually is. In the pre-market, the stock actually slipped 1.64%.
Oh, really?
Yeah, investors were kind of digesting the quality of that beat and getting a little spooked. But by the closing bell, shares had rallied hard to close up 4.35%.
Okay, quite the reversal.
Mostly because analysts from BMO and D.A. Davidson hiked their price targets during the session, which, brought some confidence back.
Well, let's look at where that revenue beat actually came from, because sales growth has to come from somewhere.
Right.
They had a 3.8% comparable sales increase. But here's the catch from your notes. That growth came entirely from a 3.6% jump in foot traffic.
Yeah.
While ticket sizes, the amount people actually spend per trip, were completely flat.
And that is the macroeconomic reality just playing out in real time. I mean, inflation has been squeezing discretionary income, so consumers are making more frequent trips to Target for absolute essentials.
But they're keeping their wallets shut for the big stuff.
Exactly. They're tightly shutting them for those bigger optional purchases. We see that clearly in the category breakdown. Groceries and snacks were up 15%, and smaller items, like Legos, were up 30%.
Wow, 30%.
Yeah, but their home and apparel segments are still seriously dragging.
It feels like a fundamental disconnect in their store strategy, to be honest. The groceries and the essentials are acting like a magnet getting you through the door, but the apparel and home goods sections are like a broken trap.
Yeah, that's a good way to put it.
They just aren't capturing your discretionary dollars while you're in the building. It's like a house that looks great in the kitchen but is a total mess in the living room.
Right. They are winning the pantry, but losing the closet. Now, to be fair, they are finding growth in other avenues to offset this. Digital comparable sales jumped 8.7%.
Okay.
And that was fueled by a massive 25% surge in same-day delivery.
Mm-hmm.
They're also heavily leaning into non-merchandise revenue. So things like their Roundel advertising network and Target Circle 360,
Oh, right.
those high-margin areas grew over 20%.
Well, speaking of high margins, the report highlights a 33.7% gross margin and a 9.6% operating margin.
Yeah.
But looking at your research, there is a giant asterisk next to those profitability numbers.
There is.
There's a one-time $994 million tariff refund baked into this quarter. I mean, that single refund added 370 basis points to their margins and $1.65 to that EPS number.
Right.
So doesn't that make this massive earnings beat kind of an accounting mirage?
It absolutely inflates the headline numbers, which is exactly why you saw that pre-market dip. Smart money saw the tariff refund masking the core performance.
Right.
But if you do the math and strip away that nearly billion-dollar one-time bump, the underlying retail engine is actually showing signs of life.
Wait, really? Even without it?
Yeah, excluding the refund, EPS still grew 20% year over year, and operating margins expanded by a very real 70 basis points.
Okay, so the core business is grinding out improvements, even if it's not quite the blowout the headline suggests. I guess that explains why CEO Michael Fidel sounded so confident about the durability of their store traffic.
Yes, and how they're getting that traffic is crucial. They've slashed prices on over 10,000 items.
Yeah, I saw that.
It's a calculated, expensive bid to keep you coming back for those essentials. And they are doubling down on the physical experience to try and fix that broken trap you mentioned.
The remodels.
Yeah, they're deploying a $5 billion CapEx plan to remodel 130 stores, redesigning those spaces to hopefully convert that grocery traffic into higher margin apparel and home sales.
But this strategy is like a total tightrope walk for anyone invested in the stock. I mean, all those price cuts squeeze margins, and right now, Target's valuation is highly demanding.
Very.
Their forward price-to-earnings ratio is stretched to near 20 times, which is way above their historical average of 14 times.
And when a company is priced for perfection at 20 times earnings, The market leaves zero room for execution errors.
None at all.
They absolutely must nail this physical store turnaround, especially since using groceries as a loss leader only works if the rest of the store is actually converting.
Right. And they won't have future tariff refunds to pad the bottom line if they mess it up. Well, if you found this breakdown helpful and want to stay ahead of the market, make sure to follow the show for daily earnings coverage.
We'll be tracking all the major retail reports this week.
For sure. And we will leave you with this to ponder. If Target's traffic relies on aggressively cutting prices across 10,000 items, how much margin compression are they going to face in 2027 when they run out of one-time tariff refunds to offset those massive discounts?